Okay, just listen for a second, because this is important. Silver dropped from about $120 an ounce to 85 in under 48 hours. That's roughly 30% wiped out almost overnight. And here's the part most headlines are missing. While Western prices were collapsing, Shanghai silver barely blinked, holding near 122. That's a 40+% physical premium over where paper silver was trading in New York and London. Both Western futures data and Asian spot pricing confirmed this divergence at the exact same time. That doesn't scream demand collapse. It screams stress in the market structure itself. Stay with me, because I'm going to show you what actually caused this move, why it matters right now, and how you can recognize this pattern before it hits again. If you're holding silver, if you're watching precious metals, or if you're trying to understand how markets actually work when leverage breaks, what I'm about to explain will change how you see these moves forever. Before I explain what caused this, let me teach you something most people never really internalize about silver. Silver isn't just a metal, it's a leverage machine. It behaves like a coiled spring under constant pressure. When it runs harder than almost anything else. We're talking moves that make even volatile tech stocks look calm. And when it snaps back, it doesn't politely retrace 5 or 10%. It can drop 20, 30, even 40% in days. Think of it like a crowded theater with one narrow exit. As long as everyone's calm, the system works fine. People file out in an orderly way. The second panic hits. It doesn't matter how strong the building is or how wide that exit seemed before. People get trampled trying to get out all at once. That's silver. The underlying demand can be solid, even tight. Physical inventories can be low. Industrial orders can be strong. But the paper market, the futures market where most of the price action happens, can still implode because leverage turns momentum into fragility. And if you don't understand that difference between the physical metal and the paper contracts, these moves feel random instead of mechanical. They feel like chaos when they're actually following a very predictable script. Here's what you need to understand about how silver trades in the modern market. Most of the price discovery doesn't happen at coin shops or mining operations. It happens in futures markets where contracts represent silver that may or may not actually exist in deliverable form. Traders use margin, which means they're controlling large positions with relatively small amounts of cash down. That leverage works beautifully when prices are rising. A 5% move in silver can mean a 25 or 30% gain on your margin account, but leverage cuts both ways. When price moves against you, that same math becomes a nightmare. And here's the thing. Silver is one of the most volatile major commodities on the planet. It swings harder than gold. It swings harder than copper. It can move 3, 4, 5% in a single session on no real news. So when you combine that natural volatility with high leverage and a crowded trade, you've got all the ingredients for what just happened. If this is making sense so far, drop a comment below and let me know where you're watching from. I want to know how many of you saw this coming versus how many of you got caught off guard. Because understanding this pattern is the difference between getting wrecked and seeing opportunity when everyone else sees disaster. Now here's what's actually happening. Let me break down the sequence in plain language, step by step, because this is where most analysis gets it wrong. Silver went parabolic. From the mid-double digits, it surged toward 120 in a very short window. We're talking weeks, not months. That kind of move doesn't happen because of steady industrial demand or gradual investment inflows. It happens because leverage is piling in. Futures traders, momentum funds, algorithmic systems, even short-term speculators, they all stack positions using margin. They're not buying physical metal. They're buying contracts that give them exposure to price movement. So when price starts slipping, even a little bit, margin requirements rise. Brokers look at your account and say you need to put up more cash to maintain your position. Some players can meet those calls. They wire more money, they stay in the game. But some players can't meet it. Maybe they're already maxed out. Maybe they're managing other positions that are also under stress, so they sell. They have no choice. That selling pushes price lower, which triggers more margin calls across the entire market, which forces more selling. That's the cascade. This wasn't miners dumping supply onto the market. This wasn't industrial buyers canceling orders because demand dried up. This was paper silver deleveraging itself in real time. And here's where it gets mechanical. Once this process starts, it feeds on itself. The first wave of selling hits the market and price drops 5%. That triggers the next layer of margin calls. More forced selling. Price drops another 5%. Now you've got traders who were profitable yesterday suddenly staring at losses. Some of them bail out voluntarily before it gets worse. That adds to the selling pressure. Meanwhile, algorithmic trading systems see the momentum shift, and they flip from buy programs to sell programs. They don't care about the story. They don't care about fundamentals. They see price-breaking support levels, and they sell. All of this happens fast. We're not talking about a gradual decline over weeks. We're talking about a waterfall that plays out in hours and days. The market becomes a one-way street. And when you're in a leveraged position in a one-way market, your only options are hold and hope or sell and survive. Most people choose survival. But here's the part that should make you pay very close attention, because this is where the story gets interesting. At the exact same moment Western paper prices were free falling, Shanghai held firm. Physical buyers in Asia didn't step away. They stepped in. You had silver trading at $85 on the COMEX Futures Exchange in New York, while physical silver in Shanghai was being quoted at $122. That's not a small difference. That's not a rounding error. That's a structural divergence that tells you something critical about what's actually happening. When paper collapses and physical doesn't, you're not watching demand vanish. You're watching forced selling in one market while actual buyers in another market see value. The physical buyers don't care about margin calls. They're not leveraged. They're buying metal to hold or to use in manufacturing. And they're looking at these prices thinking this is an opportunity, not a crisis. That divergence between paper and physical is the confirmation. It's the signal that separates a real demand collapse from a technical breakdown. If industrial buyers were walking away, if jewelry demand was falling off a cliff, if coin sales were drying up, you'd see that show up in physical markets too. Premiums would compress. Dealers would be offering discounts to move inventory. But that's not what happened. Physical premiums spiked. That tells you the fundamental picture didn't change in 48 hours. What changed was the structure of the leveraged paper market. And once forced selling starts, price discovery takes over. Price discovery doesn't care about your cost basis. It doesn't care about the bullish article you read last week. It doesn't care about the news headline of the day. It cares about one thing. Where is the next willing buyer? And in a forced liquidation event, that next willing buyer is a lot lower than anyone wants to admit. Now let me show you why this pattern matters, because this isn't new. This is the exact same playbook we've seen before, and if you study market history, you'll recognize it immediately. In 2008, silver was cut in half during the financial crisis. It went from around $20 down to under $9 in a matter of months. And people looked at that and said, well, obviously demand collapsed because the economy was falling apart. But that's not what happened. Demand didn't collapse. Leverage had to unwind. Hedge funds and speculators who'd been long silver had to sell everything to meet redemptions and margin calls in other markets. Silver got caught in the deleveraging wave. Meanwhile, if you looked at physical markets, mints couldn't keep up with demand. Premiums were spiking. People wanted the metal. But price kept falling because the paper market was in liquidation mode. Fast forward to 2011. Silver hit its all-time high near $50 an ounce in April. Then exchanges hiked margin requirements multiple times in a single week. That forced massive liquidation. Silver crashed from 50 to 30 in days, then kept falling to under 26 within a few weeks. Was that because the fundamental case for silver disappeared overnight? No. It was because margin hikes forced leveraged players to sell. The same thing happened in March 2020 during the COVID panic. Silver plunged from over $18 down to $12 in a matter of days. And you know what happened next? Mints ran out of product. Physical silver was impossible to find. Dealers were quoting $4, $5, $6 premiums over spot price because demand for physical metal was overwhelming. But the paper price kept falling because futures traders were liquidating positions in a panic. Every single time this happens, the first move feels like the end. It feels like silver is going to zero. The headlines get apocalyptic. The comment sections fill up with people saying, "I told you so," and this bubble finally popped. But zoom out, and you see the pattern. Sharp collapse driven by technical factors and forced selling. Chaotic volatility as the market tries to find a floor. And then either a violent rebound once the selling pressure is exhausted, or a deeper retest that flushes out the last weak hands before the next move higher begins. The larger story, the one that plays out every single cycle, is that silver always punishes leverage before it rewards conviction. If you're holding physical metal with no margin, you can ride through these moves. If you're over-leveraged in futures or options, these moves destroy you. And here's what most people miss when they study these historical examples. The rebound often happens faster than the collapse. In 2008, silver bottomed in November, and by the end of 2010 it had more than tripled. In 2011, after the crash from 50, silver spent a few years consolidating, but then rallied hard again in 2019 and 2020. In March 2020, silver bottomed at 12 and hit 30 within 5 months. The pattern repeats. Forced liquidation creates opportunity for patient buyers, but you have to survive the liquidation first. And survival means either staying unleveraged or being disciplined enough to cut positions before they cut you. Now let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this just keep falling? Absolutely. If liquidation resumes, if another wave of margin calls hits, if macro conditions deteriorate further, that $70 to $75 zone comes into play fast. And if that breaks, you could see people start whispering about even uglier numbers. 60, 50, who knows? The thing about forced selling is it doesn't stop at logical support levels. It stops when the last forced seller is done. So anyone telling you with certainty that 85 is the bottom is guessing. They don't know. I don't know. Nobody knows. And here's the thing about manipulation claims, because I know some of you are thinking about this. Yes, large players matter. Yes, market structure matters. Yes, there are concentrated short positions in silver futures that influence price action. But sitting around arguing about villains and conspiracies won't help you make decisions. It won't protect your capital. It won't tell you when to buy or when to step aside. You can believe the market is manipulated and still lose money by fighting the trend. You can be right about the long-term story and still get wiped out by short-term volatility. Focus on what you can control. Watch price behavior. Watch volatility indicators. Watch premiums in physical markets. Watch what other assets are doing. Markets tell the truth through mechanics, not through opinions. The price action right now is telling you that leverage broke. Whether that's because of manipulation or organic selling or some combination, it doesn't actually matter for your decision-making process. What matters is recognizing the pattern and responding appropriately. Could the fundamental story be broken? Could industrial demand actually be collapsing? Could we be heading into a recession that kills silver demand? Yes, those are real possibilities. But if that were the story, you'd see it show up in other data. Copper would be collapsing too. Manufacturing PMIs would be rolling over hard. Physical premiums would be compressing, not spiking. So far, that's not what the data shows. This looks like a technical event, not a fundamental shift. But I could be wrong. That's why you watch the evidence and stay flexible. There are probably 3 types of people watching this right now, and I want to speak to each of you directly because your situation is different, and your response should be different. First, there's you if you're a long-term silver holder who believes in the metal as a store of value or as a hedge or as part of a broader strategy. You just watched a huge chunk of value evaporate from your position. Maybe you're down 20%, maybe you're down 30%. That hurts, I get it. The temptation right now is either to panic and sell, or to double down and buy more because it's cheaper. Here's my advice. The question for you isn't emotion, it's confirmation. You don't need a bounce tomorrow. You need stabilization. You need to see that forced selling is done, and that price can hold a level without making new lows every other day. If silver holds that 80 to 85 zone and volatility starts to cool down, your patience makes sense. You can ride it out. But if this breaks lower and volatility stays elevated, you need to ask yourself honestly whether you're holding because you believe in the thesis or because you're hoping to avoid realizing a loss. Those are 2 very different things. Second, there's you if you're a trader, someone who's looking at this move as a potential opportunity to get in or to play a bounce. For you, timing matters more than belief. You don't care whether silver goes to $500 in 10 years. You care whether it bounces from 85 to 100 in the next 2 weeks. Here's the thing. Trying to catch a falling knife is how traders blow up accounts. You want signs that forced selling is done, not a heroic guess about where the bottom is. Wait for stabilization. Wait for a higher low. Wait for volatility to compress. Don't try to be the hero who bought the exact bottom. Let price prove itself first. If you miss the first 5 or 10% of the move, that's fine. You'll still catch the meat of it if this turns into a real reversal. But if you jump in too early and this keeps falling, you're just adding yourself to the list of people who have to sell on the next leg down. Third, there's you if you're on the sidelines completely. Maybe you never owned silver. Maybe you sold weeks ago. Maybe you're watching this thinking, thank God I wasn't in that. And now you're wondering if this is your chance to get involved. For you, discipline matters more than anything. Just because something fell 30% doesn't mean it's cheap. It might fall another 30%. Let the market show its hand before you commit capital. If you want exposure to silver, wait for signs of stabilization. Wait for the trend to shift. Or if you're really patient, wait for the next bull phase to confirm itself before you step in. There's no prize for buying the bottom. There's only profit for buying right. Different paths, same principle. Let the market show its hand. Don't impose your hope or your fear onto price action. Respond to what is, not what you want it to be. So here's what I want you to answer in the comments, because I'm genuinely curious. Are you holding silver right now? Did you buy this dip? Are you waiting? And more importantly, what's your plan if this goes lower versus what's your plan if this stabilizes? I want to hear how you're thinking through this, because the best learning happens when we share perspectives. Now let me tell you where I stand, because I think you deserve to know how I'm approaching this. I'm not panicking. And I'm not blindly buying. I'm watching. First, I'm watching that 80 to 85 zone like a hawk. That's the first test of whether selling pressure is truly exhausted or whether we're just in a temporary pause before another leg down. If silver can hold above 80 and start building higher lows, that's your first signal that the forced sellers are done. If it breaks through 80 with conviction, I'm stepping aside completely until we see where the next level of support shows up. Second, I'm watching Shanghai and physical premiums very closely. As long as Shanghai stays above roughly 115 and premiums remain elevated, physical demand is sending a very loud signal that the fundamental picture hasn't broken. That divergence between paper and physical is your roadmap. If that gap closes because physical premiums collapse, that would concern me much more than another 5 or 10% drop in paper price. But as long as that divergence holds, it tells me this is technical stress, not demand destruction. Third, I'm watching volatility itself. When volatility cools down, when daily ranges start to compress, when price stops making these wild 5 and 10% swings, that's usually a sign that forced selling is done. Volatility is the signature of panic. When panic subsides, markets can start to find equilibrium again. I want to see silver trade in a tight range for several days before I'd consider this move over. Based on my analysis, this move was mechanical, not emotional. It was structural, not fundamental. The underlying demand picture didn't disappear in 48 hours. Industrial consumption didn't collapse. Physical buyers didn't walk away. What happened was leverage unwinding in the paper market, pure and simple. The fundamentals for silver, the long-term fundamentals around supply constraints and industrial demand and monetary concerns, those haven't changed. What changed was the price you have to pay to access those fundamentals. And in the short term, price is determined by whoever has to sell, not by who wants to buy. If history rhymes, and if silver can stabilize here and prove that forced selling is exhausted, the next move could be significant. I'm not making a prediction. I'm not telling you silver's going to 150 or 200. I'm telling you that, historically, after major liquidation events in silver, the rebounds have been sharp and fast. But that only happens after the liquidation is truly complete. We're not there yet. We might be close. We might have another leg to go. I don't know. What I know is the pattern. And the pattern says, watch for stabilization, watch for confirmation, and don't try to be a hero. I'm not a financial advisor. This is not financial advice. Everything I've shared here is my personal analysis and my personal approach. Do your own research. Make your own decisions. Understand your own risk tolerance. If you can't handle another 20 or 30% drawdown, then silver might not be the right position for you right now. And there's no shame in that. Knowing yourself is more important than catching every move. If you made it this far, you're the kind of person who thinks critically instead of reactively. You're someone who wants to understand how markets actually work instead of just following the crowd. That mentality will serve you well, not just in silver, but in every market you ever trade or invest in. The ability to separate noise from signal, to recognize patterns, to respond instead of react, that's what separates people who survive volatile markets from people who get destroyed by them. If this breakdown helped you understand what's actually happening, hit that subscribe button and share this with someone who needs to see it. The algorithm doesn't show this kind of analysis to people unless you engage with it. And if you want to stay ahead of moves like this, you need to be seeing content that teaches you how to think, not just what to think. Drop a comment, let me know what you're watching, and let's figure this out together. Stay sharp out there. Think critically. Verify the data yourself, and make your own decisions based on evidence, not emotion. I'll see you in the next one.